Hi, I'm Jim Crider, and this is the Intentional Living Podcast, where we have conversations about how to use your resources, your time, your money, your talents, for what's important to you in life in an efficient and effective manner. I'm glad you're joining with us today, and I look forward to this journey with you. In today's episode, I'm joined with James Lavish. James is a chartered financial analyst, a hedge fund manager, and the author of a weekly newsletter called The Informationalist. Now, James and I today, we talk through the current macroeconomic landscape, the looming debt spiral, and Bitcoin. If you'd like to learn more about James or follow his writings and thinkings, you can follow him on Twitter at James Lavish, or go online to jameslavish.com/newsletter to subscribe to his weekly newsletter. We'll also have those links below. Let's get started. Yeah. So, James Lavish, thanks for being here.
Well, hey, man, it's good to hear. Can you hear me? Is this good?
I can hear you real good. Now, glad you're here. I love your thoughts and your writings, and I mean, you're on tons of podcasts, and I'd love to have a conversation with you today about, I guess, your views on, I mean, the debt spiral and what in the world does that mean to non-Bitcoin Twitter people, and where we are in the macroeconomic landscape, and what do you think the end game of where we are right now will result in? I guess I know this is like six things, but also like, how in the world do we get to where we are right now? Like we've got quite the mess on our hands. What's the way out? Can the Fed fix it? And how did we get to this place? So here, talk through all of that. You have 20 minutes. I'm just kidding.
So the answer is no. There's, I mean, look, well, first of all, thank you for having me, Jim. I appreciate it. I'm honored to be one of your early guests on this new show, and I'm sure it will do fantastically. So, and happy Friday. I'm in kind of a Friday mood, so I'm going to warn your viewers who may be used to me going a little bit debt spiral doom loop podcasting. But I mean, if it gives you any idea of how my mood is today, I'm wearing a Pink Floyd t-shirt. I mean, I'm still kind of, I'm in business mode here because it's a work day, but,
well, you know, the James that I know on a personal level is laid back in Colorado, taking it easy. So this seems right in line with my familiarity with you. So nothing out of the ordinary here.
I get sometimes people ask me if I could just take an hour or two on a Monday morning off to just not freak them out for the whole week. But yeah, I like to, honestly, I just like to tell the truth. And really what's been going on the last year in particular is I've just been trying to help people see what's going on, trying to get and make it relatable to them to understand where we are, where we're going. And I mean, I'm an optimist, and I'm a diehard optimist forever, perpetual. And I believe that we're going to find a way out of this. I believe that Bitcoin in particular is a key component of that. But your main question is like, where are we? How do we get here? And where are we going in the macro world? Like and it all comes down to money. So when I talk to people about, what I work on and what I focus on, I typically just try to explain to them how the money is broken and how the system is broken. And so, you know what it's like when you have a family that some people believe in this political party and other people believe in this political party. And, and you can tell it's Friday because I keep saying, I'm in real chill mood. But the bottom line is it's not either political party. You and I and Jeff Booth had this conversation, I think, when we were standing there in the lodge in Telluride a few weeks ago. And the bottom line is it's the system that's broken. It's the system of money that's broken. It's the incentives that drive the decisions around that money that is broken. And so when we look at these massive and gargantuan and mind-numbing numbers of the Treasury piling on $2 trillion of debt in just the last few months. It's almost inconceivable. You just can't wrap your brain around it. And you're like, well, how is that possible? And who's buying it? What's going on? And what does it mean? Are we collapsing? The answer is no, we're not collapsing, not today, but we are setting the stage for a monumental collapse. And that's the problem. And that's what I want people to understand, is that we can't do this forever. And the Treasury itself knows it. So people are blaming the Treasury, but let's call it what it is. The system is broken. You have the White House and legislators. They're up in D.C. and they make law. And in that law, part of that law is the budget and what we spend money on as a country. And they spend too much money. Now, the Treasury's job is just to facilitate that spending. It's to make sure that whatever is signed into law and whatever we have agreed to spend money on, the Treasury can facilitate that. And they do that by trying to balance a budget and by issuing debt in times of need. Well, we've been in a time of need for a long time now. We've been running perpetual deficits because we spend too much. We don't produce enough. And that's really not even the problem. We produce plenty as a nation. I mean, you and I are sitting here on a Friday working hard, and we actually are working. People say, like, they'll look at this, say, "Oh, you're doing a podcast." They may not understand all that goes into it. I understand. I've done it. I understand what goes into this. This is work, and it doesn't just start with flipping a switch. And you have a lot of components that go into this. You're buying software, you're interacting with people, you're trying to maximize your reach. You're spending money on devices and inputs, and there's a lot that goes into it, and that's production. And we're blessed to be doing these things, pontificating on these things on a Friday. But there are people out there, and you can't hear it, but there's construction going on 2 streets away from me, and there are people out there working every single day. And so the government taxes that, and then they take that, and that's their income, right? But they're spending way more than they take in income. And so enter the Fed. So the Fed's job is to maintain and restore sometimes confidence in the US dollar. And how do they do that? Well, their job is to, they say they've got two mandates: full employment and low inflation, right? And their definition of low inflation is a constant 2% annual rate. I don't know where that came from. I mean, I know it came from Europe, half a century ago, but that's where we've glommed onto as a world, as a global financial system. That 2% inflation that's normal. Okay, well, we'll talk about this, but there is no normal, right? That's not normal. Inflation is not normal. So, but the Fed's job is to make sure that people have confidence in the dollar and that they have confidence in owning treasuries, which means that they have to make sure that people believe that inflation is not so far out of control that when they invest in a bond or they hold dollars, that it's not just melting away on them, that that's actually worth something at the end of that period of holding those dollars or holding those bonds. And that's kind of where we're at, where those are the three, main players in the United States financial system. And we're not even talking about the banks. They're another massive player and huge influence on that first set, right? And on that last set, right? So they are a huge behind the scenes influence. But those are three main players who are making chess moves to keep this whole charade going. And the charade is the debt charade. And that's where we're at. And that's kind of what we're looking at today. And that's what I've been trying to teach people over the last few years. That's a long answer for a Friday afternoon, but here we are.
No, you're good. Actually, I usually wait till about 2:30 or 3 for my afternoon latte, but I accelerated that one over up to noon.
Keep it going.
Yeah, little tired Friday, but no, this is great. What is this new? Like, how did we get to this place of debt and all these parties with mixed interests? Like, is
Yeah.
this a symptom of 2008 financial crisis and suddenly like this is a band-aid, or is this symptomatic of something that's been happening for longer? Like, are we the first people who've encountered this, or is this only happening right now in the US or is it elsewhere? And if
Yeah.
another question is this, maybe it's happening just here or other places, but this is the first time in history that this has happened.
It's a good question. No,
Sorry for like
it's
five questions in one.
no, it's not the first time in history it's happened, but it's different in a number of ways. The real problem, if you go back to the main problem is, and if you ask people, and you just walk around the street, you ask people, what's the US dollar backed by? They'll say two things. They'll say gold, or they'll say the military. Like those are two things that people usually will fall back on. But the reality is the US dollar is backed by nothing. It's backed by the good faith of the US government. That's it. And so what happened is 1971, Richard Nixon made a play that he knew that the way we were spending money, we were never going to be able to keep up with it. And so he took us off the gold standard, officially took us off the gold standard. And when he did that, it means that people couldn't, if you go back and look at old US dollars, it would say that they're exchangeable for a certain amount of gold, right? But they're not on that's not on the dollar anymore. All you've got is that weird eyeball at the top of the pyramid, the all-knowing eyeball. And that's the US government. And so, but the problem is they took us off that standard. So now there's no check and balance there, right? So you can just keep issuing debt and print more money, right? So this is where the issue comes in, is that the money is not really worth, it's only worth what people believe it's worth. Okay. So it's this generally accepted note that people believe, well, that's worth $100. And if I take that and I go over here, it's going to be worth $100 to that guy. Well, the United States is in this wonderful position that we benefit from the fact that we have the global reserve asset in the US Treasuries and the global reserve currency in the US dollar, which means that US dollar is the one that people are using around the world more than any other currency. But here's the issue, is that when we got off the gold standard, we started running massive deficits because there was no check and balance. There was no worry about, do we have enough gold in our vaults to exchange for these notes that we're putting out there, because now they're not exchangeable for gold. So, they're just exchangeable for dollars. That's all they're exchangeable for, so, or goods and services for whatever people believe those goods and services are, the price of those are. But the issue is that we are running these deficits, which is, and in running deficits is just spending money we don't have. Okay. So we're borrowing money in order to create productivity. Now, debt in and of itself is not a bad thing. It's not a terrible thing. If you use debt responsibly, you can own a house, you can start a business. Like if you have, I like to give this example. If you have $10,000, but you want to go start a restaurant, you've got this place that people are asking for food. There's a lot of office buildings around there, and you know that you can have a great restaurant right there. And so you've got this opportunity, but you only have $10,000, but it's going to cost you $100,000 to open that restaurant, small restaurant. So what do? Well, maybe you're able to borrow the rest of that money and open that restaurant today, right? So meaning that you've borrowed that $90,000. Now you've got 100, and you can buy your ovens and your cookware and your dining ware, and you can hire employees, and you can buy all the food, and you can, as soon as you're done with that, in a few weeks, you can open your restaurant and start generating productivity. And so that's pulling productivity from the future into today, because instead of having to work and work and work and work and save money and save money and save up that $10,000 to make it $100,000, well, now you've pulled the productivity from the future into today, and you're creating, right? So debt, and as long as you didn't borrow too much, as long as you probably would be a better example if you borrowed $30,000 against that 10. But the bottom line is, as long as you're covering your expenses, you're covering the interest on that debt and all the other expenses you have, and you're generating a profit continually that's large enough that you have the ability to ride the wave of economic cycles. Well, then you're okay. But the problem is, many people take on debt they just take on too much. And we're in that situation now in the United States where we have taken on too much debt, and we're in what we call we're in a debt spiral. And I can talk about that a little bit more, but I'll kind of pause there and let you ask questions or maybe reflect on it.
Yeah, I'd like to, because we can continue go into like what is the debt spiral, and yeah, what's that step look like? Let's keep going on that for a bit.
Yeah, pull that thread.
Yeah.
So on that thread, so okay, you're the problem with debt is sometimes you're taking on debt that has too high of an interest rate you can't really pay back. Okay, so say you're a single parent, you've got a few kids, and you hold two, maybe even three jobs. In today's day, that's not abnormal. Many people have two jobs. The last employment report showed a rise in double employment of over 100,000 people in this last
Wow.
week. It's crazy. So people are taking on second jobs because they're not keeping up. Okay, they're not keeping up with inflation. But let's just walk through that. So you so you have mandatory expenses, right? You've got your house, your car payment, you've got gas to get back and forth to your job if you're not, if you're not fortunate enough to be working remotely, and you have to actually go to an office or a facility, and you've got to pay for food. You got to pay for your kids' food and your kids' clothing, and they're growing. They need new shoes. So those are mandatory expenses. And so if your jobs are not covering those expenses, what do you do? Well, you're going to take out a credit card. It's the easiest, fastest way to make sure that you're covering your expenses. But the problem is, you're running up debt on that credit card. You're still not meeting those expenses, and you're falling behind. Well, you're eventually going to run up that credit card, and it's going to be full, and you're going to have to take out another credit card. And then eventually that's going to be full, and you take out another credit card. And now you're paying on that third or fourth credit card. All you're using it for is to pay the interest on the last two or three credit cards. And you're nowhere near making the margin. You're not meeting the margin, and you're going under. It's called the debt spiral. You can't get out of it. Well, let's look at the United States. So if you look at the United States in particular, and all fiats are in this position, or all modern fiats are in this position, the U.S. is not alone. It's just the U.S. has the benefit of being, as I said, the global reserve asset and global reserve currency. So we're going to be able to perpetuate this for a lot longer than I think people think. I believe people think, but. So, if you look at the United States, and we were to say that the United States is a company on the New York Stock Exchange, you would call it a zombie company. Why? Well, a zombie company, as you know, Jim, is a company that is not generating enough income to cover its interest expense. Okay, so typically a healthy company will be generating enough income annually to cover their annual interest expense by 7, 8, 9, 10 times. Okay, so it's not a problem at all. The United States is not only not covering it, it's at like a 0.5 coverage, which means it's not even covering the interest expense, which means that it's a zombie company. Well, the United States also has mandatory expenses, right? So you have Social Security, Medicare, Medicaid. Okay, you've got some internal expenses that are signed into legislation. These are all signed into legislation. You have to be paying these expenses every year. That's number one. That's a big chunk. Then you've got a next chunk, which is military expenses. Okay, so that's about. So if you say that Medicare, Medicaid, and all that, I mean, it's now it's kind of a moving target. But uh, if you look at last year, okay, so I kind of went through this last year, and I wrote a thread on it back in August of last year. Okay, and these have all these expenses have gone up, but if you look at it back in terms of 2022, you have expenses of entitlement expenses that were upwards of $3.7 trillion. So, and then you add on your military expenses, which is about $800 billion. Now, those are not signed into legislation, but those are long-term military contracts with defense contractors that you have to be paying these, okay? Especially if we plan on going to war in every single country. It's another issue, but so you've got about $800 billion of defense spending, okay? So now you're at about $4.5 trillion, give or take. Now, entitlements and all that they have gone up as employment goes down, that those go up, and the need for unemployment, all that's going to be rising here. But let's call it 3.5 or $4.5 trillion of expenses. Last year we were running about $600 billion of expense on interest payments. Okay, so now as a country, we're taking in. Uh, if you look at the debt clock, and I like this, and maybe we can share the screen. Is that something we can do?
I don't know. I
Let's see.
hadn't had a chance to figure that one out yet.
I don't see it. We can do that here. But for your listeners, you can just go to debtclock.com, okay, and or dot I think it's .org, usdebtclock.org, and it'll show you continuously where our expenses are, our debt, and all that. And of course, it's down right now, so I won't be able to tell you. But these come in from the CBO, okay, the Congressional Budget Office. Every single year, they put out budgets and they tell you exactly what they expect. So they're expecting to take in about $4 trillion, $3.9 trillion, okay, of tax collections this year. Okay, so these are a lot of numbers. We're going to go back. Start at the top. They're taking in about $3.9 trillion, which is 10% lower than last year. That's what they're taking in as tax revenue. And they're about to spend this year, they're going to spend about $5.5 trillion. Okay. So right there, you can tell that math doesn't work. Okay. And one of the biggest problems is the interest on our debt is growing so rapidly. Last year it was $600 billion. This year it's getting to be about $1 trillion. Okay, so we're just like that single parent who is issuing more and more debt. Okay, we're borrowing more and more money. Now we're borrowing at higher interest rates, just like on a credit card. The next credit card you get is a higher interest rate next, and that's what's happening to us. Okay, part of that has to do with just because the Fed has raised rates, but also it has to do with the market realizing that we have so much debt that's coming onto the market. They're demanding a higher interest rate for that. So now the Treasury is issuing this debt, and they're having to pay more and more interest on that. So when you pull out all of those numbers, you see that we've got this gap, okay, that's just growing and growing and growing. That deficit is growing. It's getting worse and worse and worse, okay, and so we are in what's called a debt spiral. So what is your choice? If you're the United States government and you ask me where we are, okay, this is where we are. Our deficits are growing. We issued $2 trillion of debt in just the last few months because we need to borrow money to pay for all these things. Part of that was because there was a log jam of, there were a lot of things they had to pay for in June, that because we had that debt ceiling crisis and they were holding off a lot of expenses, and they all came due. But we're $3 trillion above where we were last year. That's the only number you need to know. Okay, it doesn't even matter what the debt ceiling was. We have borrowed $3 trillion more this year. That's 10% more. Okay, so we are in the same spot as that single parent, but because we're the United States government, we have a few other options. Okay, one thing we can do, we have basically three main options and then a fourth sneaky option. But the three main options are you can either you can institute some fiscal austerity, which means cut spending. Okay, which is meaning that you're going to cut spending on certain entitlement programs because we just heard that that's the big expense. You have to cut entitlement spending in order to bring this deficit down. Well, that's just political suicide.
Yeah, that's
Gen
I
X,
think
right?
the word like I'm not much of a fan of entitlement in a lot of things, but like I think the term entitlement there is actually merited. Like that is like Social Security, Medicare. Those are things like you've literally paid in. It's not a
I,
handout from the
I
government.
paid for that.
Yeah, I
Yeah,
paid. That is mine. I am entitled
exactly.
to that.
Exactly. I've been paying for it for my entire career, and I get I get this little statement every year. It says what my Social Security payment will be if I retire at 62 or 65 or 70. It's pathetic. But I paid into it. I paid all that money into it for decades. And I'm Gen X. I'm not expecting to get much from it, unfortunately, because of what we're talking about here. Okay, but let's walk through it. You can cut spending, but that's political suicide. Neither party will do that. They'll try to push the other party to do it, to be fiscally responsible, take the blame, and then not get elected on the next round. But neither party will do it. The second thing they can do is raise taxes. Well, we know from many studies over many years and centuries that raising taxes winds up just disincentivizing productivity, and it takes away the ability for thriving companies to reinvest money into good investments that will grow productivity over time. Research and development, new divisions, new products. You can't do that if you're being taxed and it's taken away and given to the government for um, you know uh, just silly spending. So that's the second thing you can do. But so you end up getting back to the same place. It doesn't help productivity, and you wind up with the same tax dollars eventually. The third thing you can do is just issue more debt. You can, so when a bond matures and we don't have money to pay for it, we just sell another bond, take that money, pay for that first bond, and give people back their principal. They wind up buying that new bond with that principal. And so it's just this circle, right? That's the third thing we do. And we're issuing more and more debt, right? But that can only go on for so long before you get to a spot where people realize that their dollars, their bonds, they're not worth what they were before. Why? Because of the fourth sneaky option, which is allow for and hide perpetual high levels of inflation. And when you do that, you allow for inflation to create productivity in nominal terms, meaning we're producing the same goods, but those goods cost more because of inflation. And so the tax dollars are higher because of inflation. And it's really just fake productivity. And so they take that fake productivity that they tax and they use those cheaper tax dollars to pay down debt that they issued years and years and years ago. So it would be like if I borrowed $100 from you today and 10 years later, I pay you back that $100. Well, who had the benefit from that? Well, I got $100 when it was worth $100. Now I give you the $100 back and it's really worth about 50. That doesn't sound like a good deal for you. You're the one who's loaning me the money. In this situation, I'm the US government and you're the citizens. Not a good deal, especially if you're a European or an Asian country, or you're China and you're lending me dollars, you're getting them back, and you're looking at them thinking, well, these are worth a fraction of what they were. So why do you think China is letting their U.S. treasuries just mature off their balance sheet, and they're not re-upping. The same thing that Russia did. That was a tactical error for us to freeze their assets. So there was another reason for them to do it. But they don't want these dollars that are worth less and less every year. And they know that's what's going on. And you're seeing that's why the BRICS nations have been trying to, commingle and congregate and get a not a competing currency, but an option against the treasury, because they don't want to be holding treasuries anymore. They want to be able to buy oil and gas in their own currencies. So that's kind of where we're at. We're at a spot here, Jim, where we're taking on so much debt so rapidly that the market is realizing it. They're forcing higher interest rates, and the Fed has lost a little bit of control at the long end of the curve here, because it's the what we call the bond vigilantes, and I wrote all about this in my newsletter this last weekend. It's the bond vigilantes that are refusing to buy long-term treasuries at 4%. They want them higher, 4.5, 4.7, 4.8, approaching 5% now. So if you look at that 10-year treasury, it's going higher and higher. And that isn't because people think that, the Fed's going to be raising rates here. People think the Fed is going to be lowering rates next year. If you look at Fed funds futures, they believe the Fed's going to be lowering rates next year. So why is the 10-year going up? Well, because people realize that this high perpetual level of perpetual inflation is going to eat away at their dollars. And so they're not going to loan the money. They're not going to loan money to the U.S. government at zero interest rate policy anymore. They want to be paid for that risk of high inflation, perpetual inflation, that the Fed, quite honestly, is working. And they're not working with the BLS, but they are not demanding the BLS make it look any better than it really is. Because again, the Fed's job is to restore confidence in the U.S. dollar. And so the BLS, the Bureau of Labor Services, that creates the different measures of CPI and the other inflation measures, they make it look as good as they possibly can, pulling out very sensitive things like energy and housing.
Yeah, like this week. Yeah, energy, housing, used cars, and food. Was it? It was a pretty
Whatever
basic
they
stuff you
whatever
need.
they need whatever they need to pull out. Yeah, the stuff that you kind of need. Those are mandatory expenses for people. Heat their house, eat their food, drive their car to work. Like those are kind of mandatory expenses. Pay for the house.
Well, James, the secret is go buy a new big screen TV, and you just leveled out your inflationary hit because the TV's deflationary, and now
That's
you're
right.
you're breaking even. Things are good.
That's right. That's right. So
I
yeah, so that's kind of where we're at. That's the debt spiral. I wrote all about it last year in my newsletter. You can find it. It's pinned on the thread on my profile on Twitter. But in our little Friday fireside chat here, it seems depressing. It seems very, very bleak. But I'm not depressed. I'm actually optimistic. And I'm optimistic because we found this wonderful, incredible thing called Bitcoin that I think can help us out of this mess. And so, yeah.
mean, there's a couple things. So one, when I'm a very simple minded guy, so I have to keep things pretty simple. And I guess when I tie this back, like when we're talking about numbers like this, it's hard to lose touch with reality. Like I have 4 young kids. My oldest turned 6 this week, and he was saying yesterday uh, that he can count to 100 million, billion, trillion, quintillion, just start going off. And at that point, it's just you can make up words because no one even knows. Like I don't even know. Is dodecadillion like? I mean, is that 12? Whatever. Like I don't know. So we lose touch with reality once we get to these numbers. And if if a small business or a large business or a household was managing money in the same way our government is, like you'd be in big trouble. Now the government is able to kick cans a lot farther down the road, but it's very sobering to think about. This is our government. This is impacts everybody, and I would I'd be very concerned if this was my house. I'd be looking at, man, babe, we've got to downsize. We're gonna have to. We'll be living out of the car for a bit. I hope you like camping. So I don't see how this goes for the government. And you sit here, it's like, all right, obviously you have a lot of smart people thinking through this, and a lot smarter than me. But if this was my personal household, and the way this happens, we roll the debt. Like it's hilarious. A few months ago, big politician came out and said, "Hey, we've never defaulted on our debt, dude. We default on our debt regularly. It's a habit of ours. We
It's
just don't default in the same way that like we come out and say like Michael Scott, I declare bankruptcy. We're defaulting in other ways.
we're soft defaulting every single day by having inflation.
Exactly.
Inflation, yeah, the inflation number is just this number they picked out of the air, and they said, okay, why is it 2%? Well, why is it 2%? Because that's what they can get away with. 2% is like, okay, well, 2% of my income is kind of eaten away every single year. So in order to keep up with that, Jim, you've got to be getting, a 10% raise at least every few years. Are you getting a 10% raise every few years? I know that most people are not. That's number one. So that winds up creating this system that the top earners, the 1%ers, the people who own companies, the people who own assets, they get wealthier and wealthier because those things inflate every single year. Assets inflate, right? Wages don't inflate until you go in and demand them. That's what we have over 100,000 people who I think it's over 250,000 people have entered or been on strike at some point since the beginning of the summer in the United States, and that's because they're demanding higher wages. Why are they demanding higher wages? Because they can't keep up. Like they're not able to keep up with the inflation, and so the 2% is okay because it's just low enough that they almost don't even notice it. It's just it's a sneaky tax, right? And that's what is that doing? That's allowing for the government to continue this charade of debt, the debt charade. Now, your question, this is a really important thing. So people ask me all the time. They're like, "Well, why would S&P and Fitch downgrade the U.S. debt? Do they think that there's really a chance that U.S. would default?" And the answer is no. So to quote Lynn Alden here, if you are a sovereign, if you're a country that you issue debt in your own currency, you would never default. Why would you? You could just print money. And look at Japan. Okay, the Bank of Japan has been buying their own debt for so long that they now own, the Bank of Japan owns more JGBs, Japanese government bonds, than anybody else in the world. They own over 50% of outstanding JGBs. I mean, this is just insanity. They
That's what
print,
happens when you do an emergency purchase regularly.
yeah,
It's
exactly.
well,
Exactly.
so where the government is, like if this is my household, it's sort of, I mean, we're rolling over debt to new debt. That's what's happening. And that would be like, oh gosh, babe, the credit card bill's due. And I go check the mail and there's a new MasterCard there. And it's like, hey, you're approved.
Roll
Here
it
you
over.
go. Hey, let's roll it over. And the next month, hey babe, we're not going to make it. All right, hey, we just got this Visa in the mail. Let's roll it over. And you keep doing that. Um, and what's really putting the squeeze on is not just this growing amount of debt, but each time we get a new credit card in the mail, maybe initially our interest rate was 5%, but then we rolled it over to the Visa and it's 15, and we rolled over the MasterCard, now it's 20. That's right
Exactly.
now, the Fed raises rates. We're putting that pressure on ourselves. So if I
No,
again take this back to a
yeah,
basic, if this was my household and I could
mhm.
control, all right, I'm about to get a Diners Club card in the mail and I could control the interest rate I have to pay, I would say, well, heck, let's make the interest rate zero. I'll be able to actually start paying this down. Any principal I'll pay will go towards this debt at zero, and I can get myself out of this. So
Mhm.
again, this is obviously not how it works, but why not? If the government can set the interest rates for the debt, the interest rate on the debt we're going to pay, why doesn't the government just come in and say, hey, new debt payments is zero, and then yeah, we could just buy our own debt. No one else is going to like. Actually, but I don't want to say that. Could you explain to me why we don't do that as
Yeah,
as a
that's a good.
country? Because I
That's
would do that if I was an individual, could set my own interest rate.
We did that a little bit, but the problem is that when you run zero interest rate policy (ZIRP), you wind up it does become inflationary, right? And so our issue here is that the Fed is they're trying to bring down inflation by cramping demand, right? So when you crimp on demand to bring down spending. All right. So if you just think about it in terms of if you're a company, okay, and it costs you, so think in big terms, not even just individuals, big terms. If it costs you more money to borrow, then when you need capital, and a lot of companies have what's called a bank line of credit. Well, that line of credit just gets more and more expensive. It's a lot of those are variable rates, and so it becomes capital becomes more expensive. Okay, and when they go out to issue a bond, it's more expensive, and so that means their margins come down. That means their spending comes down. That means that they can't pay their workers as much, and that pulls down their profits, right? And so they're less profitable, which means that their multiples in the stock market will come down, which means that asset prices come down, which means that's less money in the pocket of people who are selling stocks or borrowing against stocks to go and spend on things. And so it all brings productivity down, and it brings eventually. Often what happens is it pushes a number of large companies or institutions to break, and then you have what's called a credit event, and you have a drop off a cliff, right? So what you'll often see here, Jim, is the Fed keeps rates high. They raise rates, they keep them high, higher for longer than they should have, and then you see a sudden spike in unemployment, and we're in a recession. And that's what's going to happen. I mean, that's very likely what's going to happen in this cycle again. So, but you can't keep interest rates that low, because it's just going to, if you lowered interest rates now, people go borrow again and go spend again. It's going to perpetuate the inflationary issues, right? So you've got to keep inflation high enough that you don't want to go into a situation like in the 80s, where we were on the edge of interest rates getting out of control, and then Volcker came in and raised rates to almost 20%. And at one point, I think they touched 20%. And so we couldn't do that now. We would cripple the government with interest expenses. That would actually be laughable. Because back then we were running at about a 30% debt to GDP, and today we're running about 125%. So that would not work. So 120, 125. So what? So that's the point, though. Go back to your statement of you take out another credit card, it's higher interest rate. Okay, let's go back to that. So let's go back to Fitch and Standard and Poor's. And why Moody's hasn't jumped on this yet, I have no idea. I cannot figure out what they're thinking. But what they tipped off to the market, Jim, is that not that there's a higher chance of the Fed of the Treasury defaulting, but rather the higher chance that inflation goes unchecked, and that if you're investing in those bonds, you're actually getting a negative real return. So inflation is higher than the interest rate you're getting on that bond. And so they tipped off the market. I mean, the market already knew this, and the bond vigilante is already out there. But they said, yeah, we agree. There is a distinct probability that you're going to get a negative real return on those bonds. And so we're going to lower the bonds from the highest rating, AAA, to AA plus. They're still, they're a great place to keep your money. You're not going to lose it all. But when you get paid back that principal, it may not be worth quite what you thought, what you planned on it being worth, because of high inflation. And so that's the issue in what you're talking about. And I 100% agree with you. We're defaulting every single day, and that's in the form of a soft default, which is called inflation.
So there's a lot of the problems. So how does this work out? Like where here's where I see things right now. Like I talk with normal people daily about money, and obviously I you know looking out my window right now to our town square, and there's people out and drinking coffee and on walks and stuff, and it's I think where things are right now, I don't think most people are aware of the gravity of the situation. Um, but I think it's about to hit. You think through just a few weeks ago, student loan payments, federally owned student loans
They kick.
became, you got to pay them again for years. It's been years. So, I mean, it's been what, 3.5 years? So 3.5 years ago, if your student loan payment was $400 a month, okay,
Mm-hmm.
well, I have $400 a month and I can go get coffee with some friends and my avocado toast once a week, once every 2 weeks. And then
Right.
when the COVID shutdowns happened, and they canceled your student loan payments for a bit, um, you suddenly had $400 in excess, and you were given some, $1,500 in those COVID payments. So you had $400 in excess to go spend on avocado toast and coffee, and you couldn't spend on anything right then. So then you saw savings rates go through the roof, the best they've been in decades, and everyone just got $1,500 to go and sock away, or most people did something in their yard or whatever. And that's when
Yep.
the coinciding of house projects with the uh, lack of production of these
And
assets.
stimulus checks that were deposited straight into people's accounts. Yeah, but that's a good point that these interest payments have kicked in again. That's number one. Number two, when you look at the demographics, Jim, the lower the lower 80% are struggling. They're taking on more debt, and it's not because they think that they're it's not because they're optimistic about the future. It's because they're struggling today. And
Yeah,
so those credit card amount, the credit card debt in this country is just going, straight in a straight line, almost exponential. Number one, and you're seeing defaults start to tick up. You
it
know,
looks almost exactly inverse of what happened in March of 2020. March, April, May 2020, saving rates were the best it's been in decades. Accounts and everything was just it was impeccable. It was
right?
great, but again, at that point, these people had $400 in excess, and they were just given $1,500. And
That's right.
then we weren't facing the reality of the taxation of this inflation yet. So suddenly, like, cool, I can do this, and people are going out and doing things. And then after several months, inflation started to pick up, and people were realizing it. And suddenly, it was like instead of going out and getting coffee daily, now I can do it every few days. Then it was once a week, and then we reached a point where like, hey, I'm back where I was. I can go out and get coffee with my friends once a week. Um, oh crud, what happens if my $400 student loan payment comes up again? And that's where we are. We were back to a point where things were just about as tight, actually more tight than they were prior to COVID, without even having these debt payments. And suddenly this is back. So I think there's a lot of people between the age of like 25 to 45 who are about to be in a lot of pain. And who knows what's going to happen, but I would not be surprised if in a few months, like the consumer spending just falls off map, and used
Yeah,
cars start getting out there. Like yeah, when we look at again a few years back, average balance of savings accounts and savings rates were phenomenal, and it was just a spike. We had this injection of capital, and then it's the inverse. It's like it's not this gradual thing. It's just sort of fallen off the map. And the other side of like credit card, the average delinquency on credit cards, the average amounts on credit cards are just
yeah,
abysmal.
yeah.
And yeah, who again, I think it's just going to get more dire. I'm curious to see how the government's going to respond to this, what the implications are going to be with homes. I mean, houses cost a fortune. I mean, the houses are like the least affordable they've been in several decades. What's going to happen? Let's say if the Fed pivots and starts dropping rates, there's pent up demand for people to buy houses. Like there's a lot of people who want to own a house right now, but the interest rates, I
Yeah,
don't
they're
think
blocking them out. Yeah,
the cost of a house has not gone down in tandem with the rise of interest rates. So the affordability is not evened out. It's
that's
just
right.
the interest rates have skyrocketed. The
Well,
house prices have maybe gone down a hair.
that's because nobody's selling. Because what are they? They're not gonna give up their 2.5-3% mortgage. Why would they do that? They
Yeah.
wouldn't. So until that happens, you're there. So what's going to happen? Well, I see it kind of in two different paths, right? So either we we kind of plunk along here and the Fed keeps rates too high for too long, and we do have that whoosh moment of a bunch of layoffs. We go into a recession, you have a spike in unemployment, and we go into like this kind of hard landing, okay? Then hard-ish landing. That's kind of the optimistic case. Um,
I
the
like how
pessimist
that's the optimistic case. Okay, what's so
the pessimistic case is that we have a major systemic, far-reaching default that has counterparty risk with contagion that produces an event like we saw back in 2008, that we have a major credit event that or in 2019 where you saw the repo market lock up. We have a credit event that forces that all markets sell off. Every single thing you own sells off. It all correlates to one, and it does it in like face melting fashion where you just cannot even believe how quickly it happens, and it all happens like a 1987 Black Monday moment where everything sells off. Everything correlates to one. Why does it happen? Well, it happens because if you're a money manager and you walk into the office and you have a massive event like this, you don't know where your counterparty risks are. You don't know where your margin calls are going to come from. You don't know what assets are worth what. You sell everything. And often you sell things that are more liquid, things like Bitcoin, because they're liquid, they trade all day, every day, 24/7. You could be selling that on a Sunday if bad news comes on a Saturday night, you know. But everything correlates to one, and you have just a drastic downturn of, you know, 10, 15, 20, 25%, maybe even more of assets. And it's extraordinarily painful. Now, the thing is, the Fed can't have that. The Treasury, sorry, can't have that. And really the Fed by extension, they can't have that. Why? Because of the deficits we're running. Can you imagine if our tax receipts go down by another $1 trillion? I mean, it would be catastrophic, you know, for this country to try to weather a period, and it'd be catastrophic for the entire world because in reality, what we're talking about is the treasury market locking up. And if that happens, then the entire financial system crumbles. So you've got to keep the treasury market going. Well, how do you do that? You do it by turning on the money printer. The treasury presses a button on the Fed, and it dumps trillions and trillions of dollars onto the Fed's balance sheet. And the Fed, through the dealers, through the bank major dealers, they go and buy up the U.S. Treasuries and keep that market going. And so that's what people are talking about when they say QE infinity. Like that's the moment. So that would be very scary. It'll be a V in my mind. It would be a V recovery where you have this steep drawdown, a credit event, and then the treasury market gets disorderly or locks up. The treasury steps in, the Fed steps in, they shore up the market, they dump a bunch of money on the market, and here we go again. And the same thing. And so I would recommend, and this is what I do, is if you don't own any Bitcoin, own a little bit. I own Bitcoin and gold and silver because I believe that type of event, in those types of events, there's going to be a flee to stores of value where you can hide money, not literally hide from the government, but hide it from the risks that are out there. And these things, they hold their value over long periods of time. And so it'll be interesting to see in this cycle what Bitcoin does and if it breaks away and really becomes that store of value that everybody's talking about. But I think that's still a ways off. I still think it's considered a risk asset. However, because of its scarcity value, it is something that would absolutely own at least 1 or 2%. If you're not a believer, become a believer, do your work, figure it out, and it may just save you. Because if the worst case scenario happens, which I don't believe would happen in this cycle, but it is out in the future, that the world just stops believing in the dollar, and then then you have to have something to protect your wealth in. And so because the entire financial system will be reset. So, but the optimism, the good news is that we do have Bitcoin, and we do have a system that we can run in parallel, that we can onboard to over the course of the next decade or two. And that's my hope, is that we run this system in parallel, and eventually that becomes what people use as a store of value as they spend their dollars. And that gives me hope, because otherwise, we can't do this forever. And as the Treasury said themselves earlier this year, we are on an unsustainable fiscal path. So do your homework and read up on it. But that's why. But I have hope, because thank God for Bitcoin. Period.
Awesome. Well, James, thanks for uh, going through and talking that out with me. That was really helpful. From again, how do we get here? Where are we? And what do we think a way out of this is? So I appreciate your
Yeah,
time
yeah,
and
yeah. Of
chatting.
course. Of course, I'm happy to be here, and it's great to spend a little time with you on a Friday, Jim. Looking forward to the next time we get out to Colorado together. That'd be fun. So,
Let's do it.
yeah. So thank you for having me, and I appreciate it.
Yes, sir. Thanks. Hey, thanks for listening to the Intentional Living Podcast. Now, today's show is simply entertainment and educational in nature. Do not take this as tax, legal, or investment advice. If you are looking for tax, legal, or investment advice, you should go talk with a tax, legal, and or investment advisor. But again, this content is simply educational and entertainment purposes. Thanks again for listening. We look forward to you joining us on the next episode.